Good morning, everybody. It's Thursday, December 21st, 5:28 a.m. Central Time. Grain markets are quiet this morning. Mixed bag of a trade. This U.S.-Mexico rail situation is getting serious.
It sure is. Politicians and trade groups have urged the Biden administration to reopen U.S.-Mexico railroad crossings. On Wednesday, several agricultural groups signed on to a letter urging the administration to reopen the railroad crossings on the U.S.-Mexico border at Eagle Pass and El Paso, Texas. The crossings have been closed since Monday as U.S. Customs and Border Patrol shifted personnel around to deal with an influx of migrants. Numerous politicians, including Senator Deb Fischer of Nebraska and Senator Roger Marshall of Kansas, are also calling on the administration to reopen the crossings. According to a Mexican official, operations should return to normal by January.
Fortune magazine says that 10,000 rail cars sitting on both sides of the border is the number right now. I hold in my hand here the letter that was sent from all of these trade groups to Mayorkas, who is our Secretary of Homeland Security. Well, this is a copy of the letter. It's not the actual letter. A couple of good quotes and interesting stuff here. This is a quote from the letter. For agriculture, nearly 2/3 of all U.S. agricultural exports to Mexico move via rail. It was our second largest export market in 2022 with $28.5 billion in sales. And this year, exports to Mexico have been a bright spot in a relatively down year for overall U.S. ag exports. Each day the crossings are closed, we estimate almost 1 million bushels of grain exports are potentially lost, along with export potential for many other ag products. We are aware of grain trains sitting at origins in at least 6 states that are unable to move, and we expect this number to grow. We have also heard of customers in Mexico telling U.S. suppliers they will begin to look to other countries if the U.S. cannot provide a resilient and reliable supply chain. And this thing is signed, this letter is signed by like every ag trade group in the United States. It's literally a full page of trade groups that sign this thing. So get your shit together, guys. I mean, this is a big deal. We've got this is a problem because our like they said in the letter, I mean, Mexico is a bigger deal this year than it's been in recent years. In recent years, we've been selling a lot of grain to China. In this particular year, especially as it relates to corn, like we said earlier in the week, 47% of our corn export book is to Mexico. So this is a big deal. The Mexican officials seem to think it's going to be resolved in January. I hope that's the case. And I'm glad that we're starting to see some pressure this week from politicians and from the trade groups. And they need to turn up that pressure as this continues, because this needs to be solved, and it needs to be solved very quickly. Let's jump to some Brazilian weather.
Rain hit key Brazilian soybean areas yesterday and into this morning. Storm clusters sit over parts of Mato Grosso and other key soybean areas to the east. Amounts could total up to 2 inches locally by Sunday. The rain is slated to turn off early next week. A dry period of 3 to 4 days is possible before rains are slated to return around January 2nd. Central and northern soybean areas continue to run moisture deficits, while southern Brazil continues to run a moisture surplus.
It's raining in Mato Grosso this morning, and soybeans are lower. I mean, that's not a big shocker. These rains should persist through Saturday, Sunday, on and off. Then you're going to be dry for a little bit. And then some of the extended stuff says that rains return January 2nd, January 3rd, somewhere in that time frame. That stuff, of course, out 10 to 15 days is not necessarily reliable. It's not a bad setup right now. There were a few different groups out with lower production estimates this week for the Brazilian soybean crop. Solaris was out with a 156.5. Some group called ITAU BBA that Reuters cited was out with a 153, and Dr. Cordonier is at 155. So the production estimates for the Brazilian soybean crop falling into the call it mid to even lower 150s in some situations.
So, if you guys have not checked out our premium content, you need to do so. Joe, can you tell me about the video you put together with Matt Bennett yesterday?
Matt's on every other Wednesday, and we talk about grain marketing. The question that we sought to answer was this: when will I have a chance to sell corn? There has not been a good chance to sell any sort of rally in the corn market for a long time. The last time we had any real material rally was in October, and it lasted for all of like a day. We popped up above $5 and Haven't been back there since. If you guys want to see the premium stuff, there's a new premium video every single business day. This is a $50 per month subscription. You can cancel it anytime. No other fee, no other obligation. Nobody will try to sell you anything else. You'll get our morning email at 5 a.m. Central. That thing is jam-packed full of information, a lot of charts and graphics that we don't show here on YouTube. And this, again, is the best way to support what we're doing here. This is independent media. We have no sponsors. The premium subs are what allow us to do this every day. Those of you guys who are premium subs, thank you. And if you're not, you should give it a shot.
Brazil supplied China with 90% of its corn imports during November, causing Brazil to surpass the US and become China's top corn supplier for the year. China has imported 22.2 million tons of corn so far this year, with Brazil supplying 40% and the US only 29%. Imports of Brazilian soybeans to China surged by 108% last month, while US imports declined by 30% on the year. U.S. soybeans typically dominate China's imports during the fourth quarter, but a bumper crop has allowed Brazilian soybeans to be discounted on the world market. U.S. shipments have also been hindered by droughts in the Panama Canal and the Mississippi River.
This should not be shocking. They're just putting some statistics behind it. But we all know that China has not really been in for U.S. corn to any material degree this year. China continues to buy U.S. soybeans. I think most of them will be shipped. There's a question about some of the sales. You know, if the Brazil crop is big enough, maybe they don't be. Maybe they're not shipped at the end of the day. But this is not surprising.
U.S. ethanol production declined last week. Weekly output of 1.07 million barrels declined slightly on the week, but increased marginally compared to the same week last year. Ethanol stocks were pegged at 22.9 million barrels. The print increased 3.6% compared to the previous week, but declined 6.2% compared to the same week last year. Implied gasoline demand was down 1.2% compared to the previous week, but up 6% versus the same week last year. On average, over the last 4 weeks, implied U.S. gasoline demand is up 3.1% versus the same period last year.
That's a really good weekly print. Ethanol stocks are growing, which they tend to do seasonally. It's totally normal for ethanol stocks to increase toward the end of the year. So we get post harvest. There's a lot of corn available. They produce more ethanol and stocks grow. The production margins are getting squeezed a little bit because the ethanol market has fallen apart. So ethanol prices, at least the Chicago Platts contract, which is indicative of what's going on in the country. I mean, it was 260 a gallon over the summer, and now we're down to $1.66 at yesterday's close. So the margins are still break even to positive by maybe 20 or 30 cents, depending on the location. And of course, every plant's going to be different. But these lower energy prices and the weakness in the broader energy complex has absolutely bled into the ethanol market.
As tensions rise in the Red Sea, energy markets remain mostly unresponsive. The U.S. and its allies are preparing to deploy naval vessels in the Red Sea to deter further Houthi attacks. In response, a Houthi leader has vowed to retaliate against the U.S. and those involved with the multinational effort. Despite the unrest, energy markets have remained relatively calm. On Wednesday, benchmark Brent crude futures gained only 0.2% to close just shy of $80 per barrel, while natural gas futures slid 0.6%. Some experts believe the disruption will be temporary and shipping companies will return to sailing through the Suez Canal in the coming months.
So there's not very many details known about this plan that Washington has to solve this. They don't know if there's going to be a direct confrontation or whatever. The terrorist group, if you want to call it that, they say they're going to strike U.S. warships if they're targeted. Good luck with that, guys. You guys have seen you've seen the map of what this does. So it essentially, if you've got to go around the southern part of Africa, it adds a ton of time, adds a ton of cost to the shipping routes. This is a big deal for oil and could be a big deal for a lot of things if it's not fixed. The shipping through this particular strait is off 14% versus last week versus the second week in December. So I don't know. This is another thing that just is not a positive for markets. Logistics has been kind of like the word of the week here, and we hope they get this out. There's been some talk that maybe this is a positive for Russia, that they can ship more oil because this thing's being choked up. So I don't know. Let's get it fixed.
So, speaking of disruptions in the Red Sea, they have caused gasoline prices to rise. On Tuesday, gasoline prices posted their biggest one-day increase since August. After a 0.6% increase, regular gasoline now costs an average of $3.09 per gallon. Gasoline prices will likely trend higher as oil prices continue to find strength on the disruptions in the Red Sea. Even with the recent price spike, gas prices are still roughly 80 cents less than this fall's average of $3.85 per gallon.
Yeah, we're still cheap. I mean, gas was 3.90 like late September, I think, nationally, and now we're 3.10 or whatever, and it may tick up a little bit. There are some concerns, maybe not necessarily related. There are some concerns that if the Fed does in fact cut, and even the idea of the Fed cutting could result in like a reinflation event. If you're like a recession person and you think that's where we're headed, that's one of your battle cries right now. Is they're going to cut too early and we're going to be back to inflation. That's going to drive a recession. That sort of talks out there. I don't think it's crazy necessarily by any means. What did cattle do yesterday?
They continued their upward trend. Feeder cattle futures closed an average of $2.40 higher. Live cattle futures closed an average of 98 cents higher. Choice box beef cutout was 30 cents higher Wednesday afternoon to close at 289.13. Select was a buck 56 lower at 261.60.
Outside
And
markets this morning, guys. Oh, did you have something else?
nope, that's it. Go ahead.
No, outside markets this morning. U.S. dollar's off a little bit. Stocks are higher. They got beat up pretty good yesterday, but the S&P's up 20. The Dow's up 150. Bonds up a little bit. Crude oil is down 35 at 73.87. Have a great day, guys. We'll talk to you on Friday.